Hey there, and welcome to Real Investment News. I'm Mike O'Neill. Hollywood, as you know, loves a sequel. It has all those familiar characters and then just adds new stuff to keep fans excited. So with that in mind, I present There Will Be No Economic Boom, Part 2. Now, in this latest post on Real Investment Advice, Lance Roberts talks about how he is still hearing from financial planners who believe that tax cuts and reforms will lead to a surge in economic growth as corporations increase those wages, hire and produce more, and consumers are going to have more money to spend. That would be nice, wouldn't it? But let's take a look at the numbers. Now, first, the tax cut. A majority of consumers will receive an average of about $1,182 in a tax reduction. But that money is pretty much already gone because of the surging costs in healthcare, which is up 8.3%. Housing is up 5.9%. Energy up a whopping 11.4%. But what about the corporations? You know, with the corporate tax cut, we heard of a lot of companies giving their employees those one-time $1,000 bonuses, but that is nothing compared to how much they are spending on stock buybacks. And this is when I go back to my favorite piece of video from over the past year.
Pardon me.
No, it's not that one, although those kids are really cute. It is this one. I've shown it 3 times now from a Wall Street Journal CEO Council last November. Now, some of the nation's top CEOs were asked to raise their hands if they plan to use the corporate tax cuts to increase their company's capital investment. And as you can see, only a few of them did, which was a surprise to the president's now former economic advisor, Gary Cohn. So, 2 months after the tax cuts, what has happened? Well, corporations have already announced $173 billion in buybacks, and they are on track to spend about $1.2 trillion on buybacks this year. That is far above anything we have seen. And as for dividends, well, right here you can see the dividends reflected in orange. We don't have the numbers yet for this year, but the number of companies who say they're going to increase their dividends, which is this blue line, well, it is climbing at least 320 so far, and this is the most ever for a February. Now, when you buy back shares, your earnings per share goes up. Now, that makes CEOs look good, and shareholders, they love those dividends. Great. But what about the employees? What about their wages? Well, unfortunately, they are not part of that rising tide. Lance just updated this chart showing the wage growth of workers split between the top 20%, which are these columns here, and the bottom 80%, which is this orange line, the orange line that is going down. Already, year over year, the top 20% has seen a 5.25% increase in their wages, while everyone else, just 1.76%. That is below the rate of inflation. Now, as always, you can read more of these charts, read more of what Lance has to say at realinvestmentadvice.com. But for me, that's it. Thank you so very much for watching. Please be sure to follow us on Facebook, Twitter, subscribe to our videos on YouTube. We have new videos coming out every day. And watch our past reports at realinvestmentnews.com. I'm Mike O'Neill, and we'll see you again in a couple of hours.